Hey everybody, and welcome to the show today. So today we're going to be diving in. We're going to be talking about 20 ways that you can get a business loan even with bad credit. So a lot of people out there think that just because you have consumer credit issues that you're not able to actually secure a business loan, but that actually could be further from the truth. There's a ton of different ways that you can get financing for your business even if you have consumer credit issues, even if you have severe consumer credit issues. So today what we're going to do is we're going to dive in and dissect this. We're going to talk about 20 of these different ways so you'll know exactly what is possible to get a business loan even if you have credit issues. So for those of you that don't know me, my name is Ty Crandall. I'm the CEO here at Credit Suite. And what we do at Credit Suite is we help companies obtain credit for their business EIN number that's not linked to their personal Social Security number. And we also help with all different kinds of business loans. So what's cool about our platform is that we work with all different types of business loans, unlike a lot of alternative lenders out there or even conventional banks that only deal with one or two. So because we deal with all legitimate types of financing, it's easy for me to be able to do a webinar like this or to do a show like this and actually show you all these different financing options out there that are available for you. Now, if anywhere during this you'd like to get approved for a loan, well, we've got a quick link for you, creditsuite.com/get funding. That's get funding with no dash in between those two words. And there we have a really simple qualifier that's like, I don't know, 5 questions, 6 questions, that just by that you'll be able to have your information cross-checked against all lending programs that are out there to know what you can qualify for, what you can't. So without further ado, let's dive in. Let's talk a little bit more. So first of all, let's start with how not to get a business loan, because this is why I think a lot of people mess up. A lot of people don't believe that financing is available to them because they go about it the wrong way. So let me kind of let the cat out of the bag and address that first, because you first need to know what not to do so you can get on the right path to know what to do. So most business owners go to their bank when they need money, but conventional banks usually deal, well, not usually, always deal with very conservative risk. So for example, if you go into a Wells Fargo, a Bank of America, a Chase, these are what we call conventional banks. Any of the big banks where you see them in the shopping centers and see them lined up down the road. Well, those banks always deal with conservative risk, right? They're government insured. So the government forces them to be very conservative with how they lend, and business lending itself is inherently risky. So to get approved there, you've got to be in business for 3 years. You've got to have good personal and business credit. So we've seen people turn down at conventional banks with 780 credit scores because of one derogatory item that's more than 6 years old. So you have to have, I say good, but near exceptional personal credit. As a matter of fact, on SBA's website, they even mention that you shouldn't even apply if you have blemishes on your credit report. And you need to have really good business credit. So not only does it need to be established, but you need to have a good business credit score. You need to have, and by the way, later next month, we're going to be doing a show on credit scoring that talks about the different credit scores that are out there. And one of the most popular scores used in the business world is called a FICO SBSS score. And FICO SBSS, you can't even get a score high enough to qualify for a bank loan unless you have established business credit. So not only do you have to have established business credit, but it needs to be good as well. You also need to have good financials, which is usually a P&L statement, projected financials, as well as tax returns for 3 years in the past for personal and business. You're also going to need collateral for 50 to 70% of what you're trying to borrow. So that's the bad news, right? I mean, you probably already know this. A lot of you are on here saying, man, I don't think I'm going to qualify for a loan. That's why I'm here. Well, you're probably right if you go to your bank. You're probably not going to get a loan. That's the bad news. The good news is that according to the Department of Revenue, less than 2% of business loans come from the big banks anyways. So that's the great news, is that, yeah, you probably can't get approved at your bank unless your personal credit, business credit is good, and your tax returns are good, and you have all these things. But the great news is that most loans that are being issued to businesses aren't coming from these big banks anyways. So conventional banks are very hard to qualify for. The great news is that most loans are coming from the big banks anyways. Okay, that means 98% of them are coming from what we call alternative lending sources. And these are alternative funding sources other than conventional banks. These are private money lenders. These are banks that other banks that aren't the big banks that don't have to play by the same rules because they're not federally insured. They're coming from these alternative lending sources. Now, alternative lenders are only looking for one lendable merit. So if you have one strength that makes you lendable, well, you can get approved. There's also a lot of funding options where you could use collateral or the credit of someone else to qualify for that we'll talk about. So let's say you don't have a lendable merit, but yet somebody around you that maybe wants to be part of your company or invest or someone you know does. Well, then that opens up more funding options for you as well. Now, there are also funds available even if you don't have a lendable strength, and that's basically through corporate credit building, and we'll talk a little bit about that option as well. So during today's show, what we're going to do is outline 20 different types of financing you can get approved for, even if you have credit issues. Even if some of these options won't work for you, we will cover options that will. So you might get all the way to the end before you find 1, 2, or 3 options that will work for you. But I put together options that if you even have an EIN, I'm going to talk about options that you'll still be able to get some kind of credit and financing if that's the only strength you have is that you have an EIN. So even if a lot of these don't apply to you, put them in the back of your mind. As your business grows, they might apply to you, and somewhere during today's show, we're going to get to at least one or multiple options that will work for you. So that's very important to note. Even if some of these options don't work, some of them will. We just might have to get through it all to get to 2 or 3, or you might find 2 or 3 at the very beginning part that can actually work for you. So the very first one I want to jump into is is also the most popular one that exists today, and it's called cash flow financing. So cash flow financing is one of the most popular types of business financing that's out there today because it's fast and easy. Like, you can literally get money in 72 hours. You don't need a lot to qualify. So it's so easy and fast to get money. This is why it's become really the most popular type of loan options that's out there. You can get approved and fund in 72 hours or less. We've actually seen these happen in less than 24 hours, but I tell people expect about a week's worth of time, but you actually can get funding in less than 72 hours. All that's needed for approval is a 6-month review of your business bank statements. So this is short-term financing. It averages about 6 to 18 months. Long. It's not long-term loans like 20, 30 years. For your first advance, you might even see terms of 3 months. So the first time you get this loan, you might get approved for 3, 6, 12, 9 months, somewhere in between. And then after you come back and you renew and you get your second loan or your third loan, then what happens is you can be offered terms as far out as 36 months, which is a 3-year loan term. But on average, they're about 6 to 18 months. Short term, we sometimes see 3 months at the beginning. Long term, we see as long as 36 months. Rates are all over the board. I mean, they literally, I've seen as low as 7, 8%, and I've seen as high as 50% or higher. Now, personally, for me, I like these ranges. I like when I see loans that offer a wide range of interest rates, because what that tells me is it tells me they deal with a wide range of risk, right? It means that low-risk people can still get great rates, and it means high-risk borrowers might pay more, but they can still get a loan when they typically couldn't get a loan elsewhere. So a lot of factors tie in to the rate you'll pay, time in business. Sometimes they'll pull your credit, sometimes they won't. How you manage your bank account, industry, etc., etc. So you can pay back daily, weekly, and monthly. So sometimes people don't like this, and it's sometimes called revenue lending, because with revenue lending, a lot of times they deduct money daily from your bank account. But the reality is there's actual options out there for weekly and monthly payback as well. So if you're low risk and you get a monthly payback on this kind of loan over 3 years, that's pretty equivalent to a normal loan anyways. If you're high risk, you might pay more in the beginning, but you'll typically get better rates when you come back and renew. But it's important to know that lower risk also can get you weekly and monthly payback. Now, you typically can get approved for about 10 to 12% of your annual revenue. So if you do $500,000 a year in revenue, you can get about 50 grand. If you do $200,000 a year in revenue, you can get about 200 or about 20,000, for example. Okay, so $500,000 in revenue, $50,000 advance. 20,000 in revenue gets you about 20,000 loan. Now, I'm being conservative, right? That's based on 10%. I've seen 12, I think maybe even 15% lent. So you could definitely get more than this loan amount, but that's a conservative estimate of what kind of financing you may be able to get. Now, there are no collateral requirements for approval, so you don't need to have any kind of collateral to offset the lender's risk, and most lenders will go as low as a 500 FICO score, and there are also lenders out there that have no credit score requirements whatsoever. What they're looking for here is that you manage your bank account responsibly, okay? And if you manage your bank account responsibly, and hopefully other people aren't having the same issue. If you can hear me okay, just go ahead and do me a quick favor and just type in yes into the questions box, because somebody actually had mentioned they can't hear anything, and sometimes you might need to reset this on your end. Okay, so it looks like, Christopher, that a lot of people are typing in yes here, so I think everybody is good. So you might just have to maybe get out, come back in, or do a quick reset on your application to make it work. Sorry that you're having sound issues, but it looks like everybody else is good, so we'll move forward. So most lenders will go as low as 500. Some don't have any credit score requirements. If you serve up 6 months bank statements and they're really good, which means you've got positive ending bank balances, you're not overdrawing your business bank account, that you're managing your bank account responsibly, we see lenders not even pull credit and issue $50,000, $100,000 approvals with this program. So it's great for you if you have credit issues, because you can get approved with bad credit or get approved with horrible credit in a lot of cases, because they're not even looking at personal credit. You've got to be in business a year. You've got to have revenue of $10,000 a month or more. I shouldn't say you have to. There are exceptions here. So maybe you've been in business for 10 months, but you do $15,000 a month in revenue and have good bank account management. In lending, we call that a compensating factor, meaning that you've got other factors that may compensate, where you can get approved if you've been in business a little less than a year. You can get approved if you've got a little less than $10,000 a month in revenue. Most lenders will lend based on these two criteria, but we've also got all kinds of other lenders that will lend even if you don't meet one of these criteria, if you've got some other kind of compensating factor. But that gives you a loose guide of what it takes to qualify. You've got to have about 10 deposits monthly into your bank account. So what they don't want here is a real estate agent, right? Real estate agents only have 2 or 3 deposits in a month. Well, if you don't have those 2 deposits next month, then you don't have any money for them to come and take out their payment. And that's what they're looking for. Do you have consistent money coming in the bank account? Do you have positive ending balances where you've got enough money for them to take payment if they do issue you a loan? No more than 10 non-sufficient funds, same reason, right? They need to make sure there's money in your bank account for them to take their payment out, and the same reason for this too, positive ending bank balance. They want to make sure you've got money in the account for them to get their payment out. If your bank account's managed responsibly, if you're not overdrawing the account, you've got a positive balance at the end of each month, you've got $10,000 a month or close to in deposits, you're probably going to qualify here, regardless of your personal credit quality. So when about half of that loan is paid back, they're going to offer you another loan. And the loan term gets better because they extend the loan term, they lower the rate. So what happens in a lot of cases is the payment moves very little. So let me give you an example. Maybe you get a $25,000 loan. Maybe your daily paybacks, I'm just going to make a number up. Let's say it's $100 a day that you pay back. Well, what happens is you pay half of that back in 3 months, and they say, okay, let me give you another $30,000 now because you've proven yourself, and your payments your long term gets longer, your rate gets shorter, so now your daily payback is only $110, $120. So your daily payback changed very small for a big chunk of money to be deposited into your bank account. That's why so many people, about 80% of people that get into this kind of loan renew and get money over and over, because all they have to do is supply 1 or 2 months worth of bank statements, and the next day they can fund, and their payment doesn't usually go up much because the terms get much better. So to get approved, all you really need is one bank statement when you do that renewal period. It's really easy to get, and once supplied, you can usually fund in about 24 hours. And like I said, over 70%, nearly 80% of our customers that we see come back and get more money because this program is so popular, because it is so fast and easy. Now, another loan program along that same line are credit lines, and we all love credit lines, right? So credit line is available with the same kind of program. If you have good time in business of about 3 years or longer, then you actually can qualify for a credit line with this program. Now, the requirements are exactly the same as I just told you, but instead of a loan, you're actually getting a line of credit instead of a loan. Well, You're actually getting both. They'll usually give you a loan, and then they give you a secondary credit line alongside the loan that you can also use as well. Now, you've got to have excellent bank account management for approval. Remember, this whole process, or this whole program of revenue lending, is all based on good bank account management. If you manage your bank account responsibly, the lender has security in the fact that they're probably going to get paid back, and then they lend you money based on that security. Well, if they're really confident because you have really good bank account management, you've got some time in business, again, maybe it's not 3 years, maybe it's close to, and that's a compensating factor, well, then that can open up a line of credit for you. Now, remember what I said. Maybe you're not here yet. Maybe you're 9 months in business and you're not at 3 years, but you want to put this in the back of your head because you're going to want a credit line at some point if you don't want one now. So to know that this option's available for you is going to be a good thing to store in your mind, to know that a year or so down the road that you're going to be able to jump in and possibly qualify if you don't now. Now, merchant cash advance is another program that has the same features that we've talked about here with cash flow financing. The main difference is with a merchant cash advance, all they're looking at is your credit card deposits in your bank account, not all of your deposits. So far, the program I showed you was called revenue lending, and they look at all revenue in your bank account. So they look at deposits, they look at cash deposits, they look at ACH deposits, they look at credit card deposits for that credit line and for the loan I talked about. Well, with an MCA, they only look at your Visa and MasterCard deposits. Now, American Express will loan you another loan outside of this based on only your American Express deposits. PayPal will lend you money based on your PayPal deposits. So even though I guess I'm only showing this as one program, it really is about 3 or 4, because you could use your Visa, MasterCard to get one loan. You can use American Express to get another loan. You can use PayPal deposits to get a third loan. So you can actually get 3 types of loans using these type of MCAs. So MCA loans are usually a little easier to qualify. I mean, usually for an MCA lender, all you have to have is $5,000 in deposits versus $10,000 in a lot of cases. Loan amounts are lower due to only credit card deposits being used for approval. You could still get $500,000. With either program I just talked to you about, the revenue lending or this one, you could still get $500,000. And yes, we've seen those. Not 500, but pretty close. I think we did a loan for 470,000. So you can get up to 500,000 with both of these, but since they're only looking at your credit card deposits, you're obviously going to get less in most cases than revenue lending, because with revenue lending, they're looking at all your deposits. With this, you're getting about 12% or so of your credit card deposits. Rates are a little bit higher, okay, than with revenue lending, and sometimes the lender will want you to even switch merchant accounts. That's why we don't do this a lot, because in a lot of cases, they're going to want to control your merchant account. They may make you change merchant accounts, but if you're really high risk, have really bad credit, you don't have $10,000 a month in revenue, but only have 5, this might be an option for you to get some quick money when you typically couldn't qualify for revenue lending. So equity investors, and we so far, I mean, and again, on that program, don't forget that I kind of gave you 3 different ones, right? We've talked about revenue lending so far. We talked about the revenue lending credit line. We've talked about merchant cash advances. But then we've also thrown in the American Express cash advances as well if you deal with Amex credit cards, and PayPal as well. So there's a couple extra ones you can get, and don't forget, you could get all 3. So you really could come in and get a merchant cash advance based on credit card deposits. Then you could turn around and get an Amex loan based on Amex deposits. Then you can come in and get a PayPal loan based on PayPal deposits, and really in one program get 3 different types of loans. So equity investors will contribute money in exchange for a percentage of equity or ownership in your company. So you've obviously seen this on Shark Tank, right? You have an idea, you have a concept, you have a basic business model. An equity investor wants equity in exchange for their money. So they're going to give you money in exchange for a piece of ownership of your company. Now, you could be as much as 60% of the equity. If you've ever seen the show Shark Tank, which I think almost all of us have because we're entrepreneurs, then you already know that, you know, obviously it doesn't always have to be 60%. Maybe it's 5%, maybe it's 10, maybe it's 25, but they could want as much as 60% or even more than that in a lot of cases. To get approved, investors typically want to see a proven business model in sales or a great idea with patents. So we see this if you've ever seen the show Shark Tank, right? You know, they pitch their idea, and one of the first questions somebody always asks is, do you have sales, right? And If they don't have sales, then Mr. Wonderful steps in and says, well, then what you have here is a hobby, right? So they want to see a proven business idea for a reason, because most businesses fail because they don't have access to capital, which hopefully I'm going to help you fix that over the next course of this hour. And the second reason is because of mistakes made by managers, mistakes made by owners. So, you know, having a good idea is one thing. Being able to execute it and actually turn it into a successful business is a completely other thing. So in a lot of cases, equity investors want to see that not only do you have a great idea, but you're capable of running a business, which means that you have sales. You have a real business that's doing business, that's collecting money, that's making sales. Or in other cases, then what they need to see is a great idea that you have a patent, that you have something that's unique that nobody else could duplicate and copy. And again, if you've ever seen Shark Tank, we see this all the time as well. If you don't have something that has a patent and it's not unique to you and anybody can do it, well, Mr. Wonderful will flip his lid and say, look, you will be squashed like the cockroach you are, or something crazy comment like that, because that's what they want to see. A proven business model with sales, A, or B, which could be a really cool invention that solves a problem that has some kind of patent that makes it unique to you. Now, there are many private investors who will lend money to an established business as well. And private money and equity money is two different things, because equity investors want equity in exchange for money. Private investors don't want money in exchange for this as well, okay? So this being said, private money is completely different than equity, because with private money, they're going to give you money for some kind of return, and in most cases, they don't want a percentage of equity ownership in your business. So usually they're looking for credit scores of about 650 or higher, but again, we see private investors that go much lower than this, so even with average credit, you can get approved. You could sometimes get approved with bad credit, but they typically want to see somewhere between 580, 640, 50 scores conservatively. You'll need tax returns. You've got to show tax returns that show that your revenue is increasing from year to year and that you're netting some profit. And the bigger your growth and the higher the profits, well, then the easier it is to get approved. So what they're looking for here is a company that, first of all, has tax returns that show that your revenues are climbing from year to year, that you're growing. And second of all, that you're claiming some kind of profits, not a loss. Look, we are all taught, especially by our accountants, to write off everything we can. My accountant tells me to pay a year's worth of advertising up front at the end of every year just to blow the money out of our bank account so we don't pay taxes on it. This is how a lot of accountants guide us to do business. And it makes sense, right? The corporate tax rate could be 40%. So if you have 100 grand in your bank account at the end of the year, then IRS takes 40 grand of it, right? The government takes 40. So this is why they say spend everything you can. Here's the problem. When it comes to business lending, if you really want long-term low-rate financing, it is completely based on your tax returns. So if you ever really want to get a long-term low-rate loan, then you need to make sure that you're claiming profits at the end of each year, even if it's a little bit of profit. So for those of you that say, I don't have your 2 years tax returns, I don't have a 600 or 650 score, that's okay. At least now you know what it will take to get the best kind of financing you're going to want to get. Long-term, low-rate financing is based on tax returns. So start making sure that you're claiming a profit on those tax returns, so a year or 2 years down the road, if you can't qualify now for this program, you will be able to. So you can get loan amounts from $25,000 to millions. Literally, we're doing one of these that we're about to close for 13 million bucks. So they vary wildly across the different private investors that are out there. Loans usually take about 30 to 90 days to close, much longer than a revenue lending loan. 7% plus on interest rate, so low rates, and you can get 20 years or longer in some cases, even 2 to 5 years. It depends on the loan amount, right? So the $13 million loan we're working on is a 30-year loan term. 30 years is the longest you're going to see in a business lending in most cases. But then again, if you're only getting a 50 grand or 100 grand or 300 grand, well, then they might want you to pay it back for 2.5 years, 2 years, 5 years, somewhere in that range. So we find the term and often time is determined based on the loan amount. Higher loan amounts will make sure higher loan amounts mean that you're typically going to get longer terms. So another kind of financing that could work is AR financing or factoring. And this is perfect for any business that receives orders to fulfill and isn't paid for weeks or months. So with this kind of financing, what happens is you're getting about 80% of your receivables advanced or financed within 24 hours of starting the process. So for example, let's say you have $100,000 in receivables. So let me give you a couple different examples. Let's say you're a doctor's office and you have $100,000 worth of receivables that come from Medicare, Medicaid, or insurance companies. Or let's say you're a plumber, okay, and you do work for U.S. Homes, and they build all these houses, and they want you to come in and do the plumbing for all these houses, and then you have to wait months to get paid. You have $100,000 worth of work, and you don't want to wait 3 months to get paid. Well, with AR financing, the lender will give you 80 of that 100,000, 80% the next day. So instead of waiting 3 months to get paid, and boom, 24 hours, you get 80% of that money. 80 grand hits your bank account the next day. And then the other 20% gets paid after that company pays the invoice. So in these two examples, U.S. Homes now pays that $100,000 invoice to the lender. Then they give you the other $20,000 minus their fee. Or in the other example, now Medicare, Medicaid, and the health insurance pay that doctor's office the 100 grand. You already got 80 of it. Now they give you the other 20 minus whatever their fee is. There are no consumer credit score requirements at all. So if you deal with government or business-to-business receivables, you can qualify. There's no cash flow requirements, okay? So you can even get approved if you've been in business for very little time, and rates are really low. 1.25% discount rate is all that's charged. So this is one of the cheapest kind of financing that's out there today, and it has no basis on credit score or cash flow. So even if you're a startup, even if you're in the newer phases of your business, no matter how bad your personal credit is, those factors just don't matter. They're typically going to want you to be in business about a year to get approved, and your receivables have to be from another business or the government themselves. Now, something else that kind of goes hand in hand with AR financing is called purchase order financing. And with this kind of financing, you can get financing to fulfill purchase orders for your company. There are no consumer credit requirements. There are no cash flow requirements. There are no time and business requirements. Even a startup can get approved. So let me give you an example. I always tend to default to the exact same example when I talk about this program. So let's say you're a t-shirt embroiderer, and you get an order from Busch Gardens for 100,000 t-shirts, right? And you're like, holy crap, that's awesome that I got approved, or it's awesome that I got this order, but I can't buy the $100,000 shirts from my supplier to even embroider them. I don't have the money. Well, with PO financing, the lender will give the supplier a letter of credit. So what they're doing is they're basically paying for the shirts for you, then you get them, then you embroider them, then you're able to fulfill the order. That's how purchase order financing works, is you're basically getting the financing to cover the actual purchase order so you can fulfill the order. You can get approved for $5,000 plus. There's really no limit to how much you can get approved for. Oftentimes it's $500,000 to $500,000, and you can get approved for 95% of the purchase order amount. So let's say, you get an order for 100,000 t-shirts and you're paying $2, or let's say you're paying $1 a t-shirt and it's 100,000 bucks, right? Well, you put in $5 of your own money, the 95,000 you get financing for, then you can fulfill the order, then you deliver it to Busch Gardens, they pay for the 100,000 shirts, and then boom, you're good to go. You pay the lender back their money and you're off. Okay, so securities-based line of credit is something completely different. So AR and PO, I find kind of go together, because usually if you're dealing with purchase orders, you're usually dealing with having account receivables. That's usually the way that it is in most cases. So in that example, if you're getting 100 t-shirts from Busch Gardens, well, guess what? You're going to need the PO fulfilled, but you're also probably going to have to wait months to get paid as well. So you probably need AR and PO financing combined, and a lot of cases people do. Now, securities line of credit is something really unique that very few people know about, and this has to do with you or another potential investor in your business that has stocks or bonds. You can get securities-based line of credit. So most stocks and bonds are acceptable, and you can get approved for as much as 70 to 90% of the value of your stocks and bonds. So let's say, for example, you've saved some money, you got $50,000 or let's say $100,000 in stocks or bonds. Well, you could get approved for $90,000 in financing using that as collateral. Now, let's say you're sitting there going, Ty, look, I don't have any stocks. Okay, well, this is what's important to know. But a lot of people around you do. Your friends, your family, people you work with, okay, potential people that might want to be partners or investors in the business. So let's say you're trying to get a business off the ground and you need that $100,000, you need $90,000, right? Well, let's say you need 75. Okay, well, then all of a sudden you go to somebody and go, here's my idea for this company, and they go, that is an awesome idea. Like, I'd love to be part of that with you, but I work a full-time job and I don't have the time to help. Well, you actually can help. Do you have stocks and bonds? Well, yeah, I've got, $100,000 in stocks invested. Well, that's awesome. Well, this is what we can do. We can use your stocks as collateral. You still earn interest. You still get all the benefits of them. We can get a line of credit to use to build the business. Because you're using the collateral and upfronting it, I'll give you 10% ownership of the company, 20% or 5% or whatever it may be. So even if you don't have stocks or bonds, don't write off this option, because people around you may, that then you could talk to and get them to be part owner or investor in the business using their stocks and bonds as collateral to actually qualify. They continue to earn interest on the stocks and bonds. You do as well, and the rates are less than 5%. So you're basically using the stock as collateral. In case you default, they take the stock, right? So, in this case, you're getting rates less than 5%. You're getting a line of credit, so you don't have to use the full $90,000 if you don't want to. You could use it as you need to. Perfect to start a business, and you could use your own or somebody else's to do it. So it gives you a lot of different options as well. And I know a lot of you might have questions, and what I'm going to do is I will try to get to your questions at the very end, because if I answer questions kind of as I go, unfortunately, we'll make this thing 2-3 hours. And I want to try to get people out of here within an hour, or a little over an hour, that don't have questions. And if you do, then I'll try to hang out and make sure that your questions are answered here at the end. There are no cash flow or consumer credit requirements for approval. Okay, and not bank statements. No bank statements or tax returns are required for approval. So it's pretty much light doc. You don't need bank statements. You don't need tax returns. Consumer credit doesn't matter. It doesn't matter how bad your credit is, or if you don't own the stocks that somebody else is. It doesn't matter how bad their credit is, and you don't need any cash flow verification to get approved. So a really cool option to go if you or anybody around you has stocks or bonds. Now, you can also get approved for a low rate line of credit if you use inventory as collateral. So you can get approved for 50% of the value of the inventory that you have. Consumer credit does not matter, and you won't need to verify cash flow for approval. And you can get a line of about $250,000 or more. Guys, I just showed you about 3 different ways you can get credit lines with bad credit, when most people will tell you it's not even possible. 1, you use the cash flow to qualify. 2, you use stocks and bonds to qualify. 3, you use inventory to qualify for. And even one of those options, security-based financing, you don't even have to have the asset. Somebody else can have it and you could still use it. So a lot of creative ways here to get access to credit lines if you have one of these lendable strengths or somebody around you that does. You got to have about $500,000 in inventory for approval. So this isn't for everybody, but a really creative way to get an awesome low rate line of credit if you do deal with a lot of inventory and have a lot of inventory on hand. Now, 401k financing is another really cool kind of financing that could work with you or a potential investor. As a matter of fact, this is one of the most common popular types of people that are going into a business as partners. They have 401ks. One uses one of their 401ks, one uses the other one of their 401ks, and they go in this way. This is very common for multiple investor situation. You need an IRA or 401k to qualify, or someone around you that has an IRA or 401k. Okay, so same thing. Maybe someone around you doesn't have stocks or bonds, but they have an IRA or 401k. They want to be part of the business. They can use that 401k to qualify. There are no consumer credit score requirements, no collateral requirements beyond having a 401k, and no time in business requirements. So even startups can be approved, and you don't need tax returns or bank statements for approval, and you can get approved for as much as 100% of the value of the stock. So unlike securities, stocks, and bonds, where you can only get 90%, you can get 100% financing against the value of the 401k in this scenario, and you can get a rate of 5% or less. You're basically just investing the 401k into your business versus taking it and investing it to a bunch of other businesses is what you're doing. And there's no tax ramifications. So it's based on IRS proven strategies. So there's absolutely no negative tax consequences for taking advantage of that program. Now, you can get financing to purchase equipment even as a startup. So it's interesting because a lot of people come to me and say, look, I need $100,000 in money. Well, why do you need 100 grand? I need to buy a piece of equipment. Well, you don't need 100,000 in financing. You need equipment financing for 100 grand. So know that what are you using the money for? What do you need this initial loan for? If it's for the purchase of equipment, well, you can get equipment-based financing even as a startup. Now, some lenders will go on these programs as low as a middle 500 credit score. So even with bad credit, you can still get approved. And loan amounts range from 25,000 to millions, and interest rates are 8% plus, 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 plus. I've seen somebody, or I heard of somebody, I didn't see him personally, that had a 65% rate on this kind of financing. Seems crazy, seems absurd, made perfect sense. The guy actually had a crew out de-stumping a golf course. He was building a golf course and had people out manually pulling stumps out of the ground. The guy was really high risk. He ended up getting a de-stumper, which apparently is a piece of equipment that really does exist. He paid 65% interest on it, and his payment was like $2,000 a month, but it saved him $8,000 a month because he no longer needed to pay that big crew to do it. So I don't really care that much about interest if a deal makes sense. Meaning that if I get approved for something and I can write off all the interest, that if I'm saving a bunch of money because I'm using, in this example, a piece of equipment to do it, who cares? Okay, interest rates are based on risk anyways. So the rates on this wildly vary because they deal with all kind of risk situations. Now, another option, just so you know, even though we're not talking about this, is that if you've been in business a year and you have a little better credit, well, then in the mid 600s, then you could also get equipment leasing. So you get better terms on equipment leasing than financing, but I don't think I'd really talk about that here because this is meant for you only if you have bad credit. But keep in mind, as your credit improves, equipment leasing is an option that can work for you as well. So another program is called a equipment sale-leaseback. So you can borrow against equipment you already own, or maybe somebody else owns it and you want to pledge that as collateral. So again, we're talking about options here that even if you can't qualify for this, somebody around you can qualify. So let's say you don't have a backhoe or a bulldozer or some other big piece of equipment in a factory, but maybe let's say one of your buddies does, or somebody else that wants to be part of your business, or a family member, somebody else has a piece of collateral they'd like to pledge to help you get the business off the ground or get funding. That can work as well. You can't have a current lien against it because if you have a lien against it, you don't really own the equipment, and the lender is going to undervalue the equipment by possibly 50%. So if the piece of equipment's worth 100 grand, well, they're going to lend you money based on about a $50,000 value of that equipment. And that's called a fire sale value. Very common in lending when you're dealing with collateral. If they want to unload the collateral quickly and get their money back, how much could they do so for? They always undervalue just because they need to get their money back. Now, major pieces of equipment only, the lender won't combine a bunch of pieces of small equipment, and you're going to have usually first month's payment and last month's payment required to actually get funding, and loan amounts can easily be about $2 million or higher. So there's a couple different options there, right? 3 different options, really. Equipment financing, you can get it even as a startup. Equipment leasing, you need to have a little bit better credit than you do equipment financing. You need a year in business. And equipment sale-leaseback, where you can use your own equipment, borrow against it to get a chunk of cash, and somebody else's equipment and get a chunk of cash. And just so you know, they call it equipment sale-leaseback because that's basically what you're doing. You're selling the equipment to the lender's leasing it back to you. So when you make the payments and pay it all off, well, then the equipment becomes yours again, free and clear. So that's what an equipment sale-leaseback. I mean, it's such a stellar way to get money if you have a piece of equipment to use, or somebody around you that you know has a piece of equipment to use. And I like these options because, guys, even if you don't have money, well, then if you have a good idea and you really believe you could succeed in business, then you should be able to find someone around you that has this stuff, that has a piece of equipment, that has stocks or bonds or 401ks or IRAs that can help you even if you don't have it. So some cool options regarding financing for equipment. Now, another program is you can get 100% of the financing you need to purchase and rehab residential properties. More people than ever are jumping in to the rehab, flip, and fix space. And it's cool to know you can get 100% of the money you need to buy the property and fix it through what's called a house flipper program. Now, lenders need up to 65% of after repair value or lend up to that. So these might look like they kind of are different, but they're not, because what it's saying is if you buy the house right and you buy the house at 50 grand and you know the after repair value is 100 grand, well then you could get 65,000 on that property, right? You know it's going to be worth 100 when you sell it. You got 65, you only paid 50, so you got enough money to be able to buy the house and flip the house as long as you buy it right, which if this is what you're doing for a living, you should be. You typically get a loan term of about 6 months because that's about as long as fix and flips take. Rates range from about 8% or higher. You have to have average credit on this, or right around average credit, about a 660 score or higher, a partner that does. Lenders want you to have flipping experience, and you've got to have some money or cash in hand. If you've got some experience, you did your second flip, you put some money in the bank, your credit score's right about average, about 650, 660, then you're going to be a good candidate for this program. Now, you can also get loans to buy commercial real estate, 75,000 up to 20 million. You could borrow against real estate you already own, or you could buy real estate and get 55% if you're borrowing against, or even get as high as 65% or even much higher if you're buying. Loan terms of 20 to 30 years, 4 to 8% rates, average credit or sometimes below will work, and you can get conventional and SBA loans, and we deal with a lot of private investors that deal with that kind of financing as well. So book a business financing. Now, if you're an insurance agency or if you're looking to purchase an insurance agency, then book a business financing is probably one of the best options that exist for you. You can use commissions from your insurance book of business as collateral for approval. You could typically borrow as much as 120% of what's called the surrender value of your renewable commission. So if you're not an insurance agent, none of what I said makes sense to you. If you are an insurance agent or looking to buy an agency, this probably makes more sense. The surrender value is, if you decided to close your doors, then the amount of what you would surrender your book of business back to that insurance carrier. So let's say, for example, you're a Geico agent and you decide that you're done, you're retiring, and you want to sell your book of business back to Geico. Well, that would be the surrender value, what you'd sell back to them for. You get about 120% financing against the surrender value of your book of business. You can get approved for good loan terms, 2 to 5 year loans, 5% plus rates, and average consumer credit. They're going to want a couple references, but all they really care about your book of business here. With below average or average credit, you can still get approved. This is one of these really weird kind of loans that is the only kind of loan I've ever found, and I've dealt with a lot of loans in the commercial and in the consumer space, and everybody always wants more than they can qualify for, right? But this is one of these rare loans where we typically get people approved for way more than they end up taking. So you usually can get way more than you even need or want to get. So if you're even thinking about purchasing an insurance agency or you are an agent, this is definitely something you should look into. So crowdfunding. Now with crowdfunding, and again, I know you guys have some questions and comments, but like I said, for those of you that haven't found something yet, wait till the end. We're going to cover something that'll work for you pretty much no matter what industry you're in, and I will hang around for questions. So if I don't hit something that appeals to you, which I should, I'm going to hit something that appeals to everybody, then I'll be able to give you some more insight as soon as we're done. So there's a lot of sites for crowdfunding that you can also get money for. So with this type of funding, you're basically getting money from other people that like your concept, like your idea, like you, like your potential to earn money. And if the crowd likes the idea, well, then they donate money ultimately to your project. Now, much of crowdfunding doesn't have to be paid back. It's not even really a loan. It's like free money. And this comes in a lot of different forms. I've seen people pre-sell products. Here's the idea I have. Here's what it's going to look like. And they get funding from the idea. I've seen people get crowdfunding for startups. I've seen them get for existing businesses. But in a lot of cases, the money doesn't have to be paid back. In some cases, they're even pre-orders of your product. Now, many investors in the beginning are people you know. So this is a great way. If you have a big, wide net or know a lot of people or even are good with social media, well, you could start a crowdfunding project, have some people contribute small amounts of money from the circle that you know. Then when it starts to gain steam, the crowdfunding site usually heavily promotes you, and then you have all kind of outside investors pouring in money as well. So unsecured business credit cards. Now, most true unsecured business credit cards actually do require good personal credit. But if you have a guarantor, you can still get approved for what I think to be one of the best funding programs that exist, but very, very, very few people know about. And this is why I'm showing you this. This is the only program I'm going to show you today that actually does require good credit. So why am I showing you? Because not most, but I'd say about 30 to 40% of the deals we fund on this program, they don't have good credit. They're using a guarantor that does have good personal credit to get approved. So even if this doesn't apply to you because of credit issues, you need to pay very special attention, because this is one program that a lot of people around you would sign as a guarantor if you're giving them some kind of rate of return or ownership equity in the business. You can get approved for $10,000 to $150,000 in unsecured financing for your business, which means no collaterals required. Your rates are 0% for 6 to 18 months. These accounts report to the business credit reporting agency. So you're getting up to $150,000 in immediate funding, and you're building your business credit at exactly the same time. And you can typically get about 5 times the amount of your highest credit limit account or the one of your guarantor. So let's say, for example, you got a sister, brother, mom, dad, friend, and they have a 685 credit score. And the highest limit account they have, or maybe you have, is maybe $20,000. Well, and again, $20,000 if you have bad credit seems high, but if you have good credit, that's pretty common to get $10,000, $20,000 approval accounts. So with that $20,000 revolving credit card account, you can now get $100,000 with this program. Let's say the highest credit limit account they have is $10,000. You could get $50,000 in financing. Let's say it's $30,000. You could get $150,000 in financing. So usually about 5 times the highest limit revolving account. They should have excellent credit. So the guarantor needs to have about 685 credit score, less than 3 inquiries within the last 6 months, and utilization below 40%. If they don't have this, let's say they're a 650 credit score. Let's say you have average credit, 650 credit score. You can still get personal cards with all the same benefits I mentioned, but that report to personal reporting agencies instead of business with even average credit. So this program may work for you if you have average credit, or may work for you if you have a guarantor with good credit. And the lenders will usually charge to about a 9 to 12% fee on this, and you're getting 0% for 6 to 18 months. Okay, so we've talked about a lot of options where something is needed to qualify, whether it be equipment or inventory, or whether it be, well, crowdfunding doesn't require anything. And we've talked about a lot of different options that typically you have cash flow or some kind of collateral or a guarantor that has something. Well, with business credit, what's nice about business credit is you can get really high limit credit accounts in your business name that are linked to your business EIN with no consumer credit inquiry. And I know somebody, I think Melissa, typed in something about being in the trucking industry, for example, and this is probably one of the most common type of financing we see in that industry. But there are no cash flow requirements, no collateral requirements whatsoever, and you can get immediate vendor credit approvals, and they don't even pull your personal credit. It's not linked to your social. There's no consumer credit inquiry. You're not even providing your social security number on the application. So regardless of how bad your credit is, nobody even sees your credit at all. You can get high limit store credit cards accounts in about 30 to 90 days. And then beyond that, you can get high limit fleet and cash credit cards within 120 to 180 days. So let me give you some examples here. So Melissa here had typed in All these ideas are great if you have an actual product to sell, but what about those who are in the trucking industry? Well, we've already talked about several options that could work for you, right? Securities-based financing, 401k-based financing. We talked about equipment financing that can actually be used for trucks as well. But this works perfect because truckers love this kind of program because you can get gas cards of $20, $30, $50,000. You can get a BP card and a Costco, or you can get a BP card, and you can get fleet credit cards. You can get credit cards at almost all major gas stations, right? Amoco and almost all of them. You can get high limit $20, $30, $40,000 accounts. You can also get fleet credit. Fleet credit helps you with all different kind of financing to repair vehicles, tire repair and transmission repair and all the stuff you can need. And a lot of people even use fleet credit cards to get cash out of. Actually go and physically withdraw cash from an ATM using their fleet credit cards. You can also get cash credit cards. Visa cards or MasterCards you could withdraw cash out on, or you can use in almost any location. You can even get auto financing, including getting vehicle financing, and some of our trucking companies use this more often than any other industry, all without a personal guarantee, all without a personal credit check. And all you need is an EIN to get approved. You need nothing other than an EIN. So, for example, I'm looking at my whiteboard right now. If you follow us on Periscope and Facebook, you'd see exactly the same whiteboard I'm looking at. And let me give you some recent approvals so you'll see what's possible here for you. Okay, Tractor Supply $5 grand, BP $8 grand, a Fuelman fleet credit card you could take cash out on for $16,000, a Shell card for $15, an Apple for $12,500, an Exxon for $5, an Office Depot for $15, a Costco for $20, Sunoco for $15, Sears for $15, BP for $8, Sprint, $150 per line times 12 lines, a Best Buy credit card for $40,000, a cash credit card Visa for $7 grand, a fleet credit card you could take cash out on for $40,000. Ford financing, hasn't secured her loan yet. She's in the trucking industry. She hasn't picked out the vehicle she wants. AutoZone for $2 grand, a Dell account for $40, an Amazon for $35,000. Guys, there's not too much you can't buy at Amazon. And so to get a $35,000 account with no personal credit check at Amazon obviously could be of assistance with a lot of people. A Bank of America for $11,000, an Apple for $10,000, a Home Depot for $25,000. These are all real approvals that people on our Facebook and Periscope not only report that they get, but we then pull their physical business credit reports to verify that they've gotten them. None of the credit I mentioned required a personal guarantee. None of it required a personal credit check. All you need is an EIN number to get approved. That's why I love business credit. Business credit was what I call a catch-all, because even if you can't get any other kind of loan we've talked about, you can still get business credit. Even if you don't have a lendable strength, you can still get very high limit business credit accounts, even get auto vehicle financing regardless. Now, vendor credit is sometimes referred to as trade credit. That's another option here. This type of credit is extended from one trader or vendor to another for the purchase of goods and services. And trade credit facilitates the purchase of supplies without needing payment. So again, if you want money to start or grow a business, the question becomes, what do you want the money for? Okay, if you say, well, I need it for office supplies and computers, well then why get a loan? Why not get business credit? You can get it fast, and in 2 months, you're getting $10,000, $20,000 limit accounts at places like Amazon and Dell and Apple, where you can get the office supplies, you can get the computers. Maybe you come in and say, I need this specifically, these supplies, these products. Well, a lot of vendors will issue you trade credit. Some of it reports to the Business Credit Reporting Agency, some don't, where you can then get that credit to get what you need to buy and then use your Visa card, MasterCard for the rest, or the small loan for the rest. That's a smart way to do it. You never want to get a loan and then use it to buy everything you need. Get as many forms of financing as you can, use those to buy the things you could buy them for, and then keep your loans and credit lines available to buy the stuff that you only can use cash to buy. Okay, that's the better strategy. And we have, for example, one of my friends was exactly in that same boat. She came to us, she needed to purchase a big piece of equipment for a doctor's office, and then she needed to pay payroll. So what we did was we said, this is what we're going to do. We got her $80,000 in unsecured financing, the program I told you about. By the way, her credit was not good. She used that of a guarantor to get $80 grand. The 80 grand is what she used for payroll, and then we got her equipment financing, and then we were able to have the 80,000 in unsecured financing pay for her first and last money of the equipment financing. Guys, that's how you do it. I will tell you, I've been in lending a long time, and so many people are trying to go to one source to get 100 grand, 500 grand, a million, and it's hard to do. But when you piece together the financing you need, it's a lot easier. In this case, she got the payroll and she got the equipment through two different forms of financing, unsecured and equipment, and her credit was bad. She still qualified for the equipment financing because of bad credit. She used the guarantor to get the 80 to pay the down payment for the equipment financing and to also cover payroll, and boom, she got more than she needed two different ways, even with challenged credit. That's really what this is about, and trade credit is one path that can get you there. It's often used by business organizations as a term of short-term financing. Okay, so here is a list of some of those approvals that I already mentioned earlier of people that are using business credit as a catch-all if you can't get any of the other kind of business loans that we talked about today. And also remember that even if you can't get one of the loans we talked about today, I still mapped out a way where you could use guarantors and other people to possibly get it, or you can even get that as you grow your business and get business credit, some of these other things to get you to a point where you can get some. So for example, maybe you come in and use your $35,000 Amazon account and your $40,000 Best Buy and your fleet card for 16 grand to get cash and get your business off the ground. Then your business starts generating revenue. And then 11, 12 months down the road, you've got $10,000 a month in revenue. Now you can qualify for that cash flow financing or the merchant cash advance, the merchant cash advance credit line, or the Amex, loan, or the PayPal. So when you start to piece this stuff together, maybe some of it you can't get now, but you can get a little bit down the road. Some of it you can get now, like business credit or trade credit, so you get that money to get you to a point where you start opening up some of these other options. Regardless, a lot of different options we've talked about for every single scenario today. So if this makes sense, we'll go to creditsuite.com/get funding if you have any of those criteria to qualify for the loan. I also gave you creditsuite.com/EIN to get a free guide that maps out business credit building. And if you want to talk to us more about expediting your business credit building, you can also go to creditsuite.com/EIN. So what I'm going to do before I wrap up here is just see if there's any questions. I'm going to probably hang out for about 5-10 minutes and go through any questions that you may have if you're on the live event. We also have transferred this to our podcast, and it becomes our podcast show, and this also shows up on YouTube and some other areas where people don't have the luxury of having questions answered. If you want that luxury, well, then just make sure you go to creditsuite.com/EIN. You'll get on our email list, and about every 2 weeks, we do this type of live webinar where you can actually be here and go through a Q&A at the end in a lot of different cases. So let me go through and answer questions. Chris says, this is all good, but what about people like me just recovering and have nothing to offer a creditor? I mean, it's great that people that are already up and running, but what about the guys starting from scratch? I gave you a bunch of different options, right? I gave you a bunch of options that work absolutely from scratch as a startup, and I know this was done about 13 minutes in, but you see a lot of different options, even business credit and trade credit where we ended up, you can still get regardless of personal credit, even as a startup. So we talked about a lot of those options. What about equipment financing, like used car and credit for fuel, 30 to 60 days? And that's exactly what we talked about. I talked about auto financing too. You asked this question about 28 minutes in. I just told you how to get credit for your EIN that's not linked to your social, to get both auto financing and to also be able to get fleet credit cards and gas credit cards. What kind of lenders will give credit lines based on inventory lenders? And there's not very few. As a matter of fact, I think there's only one lender we deal with in the entire country that will actually lend you money based on inventory. And you can go to creditsuite.com/get funding if you have that inventory. They have a higher requirement, about $500,000 in inventory you have to have, but all they really want to see is that you have a good inventory management system to manage your inventory responsibly, and that you also have a pretty good, through your inventory management system, breakdown of how much your inventory is actually worth. If you have that, you can absolutely qualify. And we talked about, Melissa asked about the trucking industry too. We talked about a lot of options that are specific to you. I missed some of the webinar. Can someone send me a replay of this webinar? Yes, it's because you attended throughout the entire webinar, you should get a playback of the webinar. If for any reason you don't get the playback, just email joni@creditsuite.com. That's JONIE at creditsuite.com, and Joni will actually send you a playback. Also, my company is a startup with no business credit, bad personal credit, no sales and clients yet, with 5-year business plan, but need money to start a business, 15, 20 guys for advertising to get business off the ground. Well, then you need to go with business credit, Sean. The bottom line, guys, look, money is lent by having a lendable strength. Sean, you are literally saying here that you have no lendable strength, right? You're a startup. You have no business credit. You have bad personal credit. You don't have sales. You don't have clients. Well, nobody's going to lend you money based on only a business plan because, again, you know, a plan isn't worth much. It's how you handle adversity when the plan goes wrong that matters. So what you need to do is create a lendable strength. And that's how I look at it, is if you don't have a lendable strength, you're a startup, you don't have revenue, you have bad credit, you don't have collateral, well, then you've got several options, right? We've talked about 401k and stocks and all these things where you could use someone around you that's a guarantor for unsecured financing or use somebody else's assets to qualify. And you can always build business credit. And business credit within what you're talking about, 15 to 25,000 to get the money you need, could happen within about 90 days worth of time, 120 days max. And then you give yourself a lendable strength, right? If you have none and you have bad credit, no cash flow, no collateral, nobody around you has assets, nobody around you has good credit, then at that point, business credit's about the only option that you have to be able to get money to make yourself lendable, but then also to get money in a very short period of time to get the $15,000, $20,000, $25,000 that you need to actually get the advertising staff and everything you need to get the business off the ground. Remember, guys, it's easier to get a loan when you have a lendable strength. When you have no lendable strength, then you got to hack the system and create a lendable strength using something like corporate credit to be able to do that. And I don't have a business, but I want to buy a franchise. How do I get a loan for that? Well, you can, but the problem with that is that, you know, to get a loan to buy a franchise, you're probably going to need the assets of the franchise. And I gave you a bunch of options that can work, right? You could use a 401k. You could use stocks. You could use stocks and 401k from another potential investor. You could use the credit of another guarantor or potential investor to get the 150 grand, et cetera, et cetera. Any of those options we talked about could work for this scenario. Okay, or you could use the assets of the franchise itself. If you're buying an existing franchise that has assets, if that owner will make you part of the business in a way where you could use the assets of that business to qualify, there is a way to do it. But again, if you want to use the assets of a business that isn't yours, then you're going to have to be close with that owner or that seller, because they're going to need to make you part of the owner so you have access to the assets to use as collateral. It absolutely can be done if you're working with somebody that will play ball. If not, then it's pretty tough to do if you don't have one of these lendable strengths to qualify or someone around you that can actually help you get that done. I have 2 tax liens on my credit file. Can I qualify for any of these methods? Yes, you can. Bernice, any of the business credit that I talked about doesn't even look at your personal credit, and a lot of these loans, they don't even look at business credit or personal credit anyways. So it depends. Some of them, like revenue lending, it can be harder to get approved for if those tax liens are recent. If they're older, you could still get approved, okay? And most of the other kind of financing I talked about today doesn't even pull your personal credit. It doesn't even matter. Those tax liens don't even matter, and anything to do with business credit doesn't matter as well. I have no personal credit. Business credit looks good. Like me, check. No personal credit inquiries, no social, etc. Right. Yeah, that's correct. With business credit, you can obtain credit with no personal credit inquiries, no social security number. That is correct. But people have a wrong definition oftentimes about good business credit. A good business credit isn't necessarily a good score. A good PAYDEX score with Dun & Bradstreet simply means you pay your bills as agreed. What matters is how many trade lines you have reporting. So you need to have about 5 trade lines to get those high limit store credit cards, and about 10 to 15 trade lines to get the Visa cards, the MasterCards, the fleet credit, the auto financing. The number of trades matters, Ryan. What doesn't matter as much is the score, okay? So hopefully that answers your question there. Cost to get going, for us, I'm not exactly sure what you're asking about. For loans, we don't charge you a dime. We don't charge you up front. We don't charge you when the deal funds. In a lot of cases, the lender pays us a referral fee for referring the loan to them, and we help you through the entire process. We help you understand what you can qualify for, build a plan of what you'll qualify for long term, get the deal placed with the bank, negotiate the terms, everything we help you through, and you never pay us a dime. On the business credit building, we've got a bunch of stuff on our YouTube channel, youtube.com/credit suite, for free to follow the steps to build business credit. If you want to build business credit directly with us, we do have a coaching program for that, and it ranges from $2,500 or higher. We break it down into payments, and it depends on if you just want our business credit program or if you also want to offer it as a service. So you can go right to our main website, creditsuite.com/pricing, for those details. My new business has an EIN and DUNS number, and I need money to get a jump start. I want to get a loan within business credit alone, but it's only 2 months old and has no established. Yeah, it's tough. It's tough to get a loan based only on your business credit quality with limited time in business. And that the reason for that is because your business credit report says the number of employees you have. It says how long you've been in business. It says your revenues. It says your profits. So, if you're trying to get a loan, they're going to pull your report. They're going to see what your profits are, what your revenue are, what your employees are, when you started, and they're going to take all that into account with business credit as well. But again, my question comes back to why. Why do you need a loan? If you have credit cards you could physically take cash out on, if you have Visa cards with high limits and MasterCards with high limits and 35 at Amazon and 20 grand at Walmart, what could you physically need a loan for that all that other money couldn't provide you? In most cases, if you really think about what you need the money for, the store credit cards, the fleet credit cards you could take cash out on, the Visa cards, the MasterCards, that type of financing is going to get it what you need without a loan. Loans with business credit quality alone, it can happen. But unfortunately, the other factors have to add up as well. Your time in business, your employees, your revenues, your profits, all that other stuff that shows on your business report. It sounds like here it doesn't, so that could be an issue. Just keep that in mind. I have under contract to settle on a building that's worth 200 grand. As it sits, and 500 ARV, I need 60,000 to settle, and I have to settle fast. What's the best way with bad credit to do it? Mark, I'm interested in what did you already talk to brokers on this scenario or not? There's a lot of hard money guys out there that would do something like this. If you're only needing 60 to get 200 and 500,000, so there's a lot of private investors. You're going to be looking at a private investor or a commercial settle on a building or on a commercial real estate investor is what you're looking for. So hard money options, you can go to creditsuite.com/get funding. This isn't necessarily our specialty, although we deal with a lot of real estate stuff if the deal makes sense, but our guys are typically going to want tax returns, and anybody else is too. The problem with this scenario is that you have to verify you have enough money and you're making enough to pay the payments, no matter what kind of financing you get. We deal with people with bad credit with commercial real estate, but in order to do it, you have to prove that you have the ability to pay back the loan as you would with most other loans. So if you don't have that, then unfortunately it's not going to work. So you've got to make sure that you have the ability to pay it back. If you could prove that you have the ability with tax returns, et cetera, to pay it back, there's a lot of investors that actually might be very interested in doing this deal. Okay, so that being said, guys, I am going to probably hang out and answer some questions, but I'm going to go ahead and just end this for everybody that's listening on the recording today, because I don't want this to be an hour-and-a-half session, and it probably will be if you're hanging out for the full Q&A. So I'm going to end this for everybody. Thank you all for listening today. If you're listening to this on playback, I'm going to end the recording, but then I'm going to go ahead and hang out here and continue to answer a lot of your questions. So for everybody that's listening on the playback or listening on the podcast, thank you very much for tuning in. I hope you all have a great day.